Welcome back guys to another video, and in this video I'm going to talk about types of different markets. And in types of different markets I'm going to talk about high risk market, low risk market and medium risk markets, because it's really important to know what sort of market you are investing in and how long to be in that market for and the risks associated with it. So let's go about defining what these markets are and how I view it, which is a high risk, which is a low risk, which is a medium risk market. And there are a couple of key factors that I actually look at. The first one is economic diversity. So if a location is specifically a mining town or it's hinged on specifically one industry, then I will consider that sort of a higher risk market, for example. I'll also look at historical price growth as well as population size, as well as the growth it has been having over its lifetime. And I'll also be looking at population size and growth. Now, there are some other factors that people consider into risk, like affordability, renter to owner occupier ratio, local unemployment, and you can adjust it however you like. But for me personally, when I view and I analyze properties, the first most critical factor I look at is the top three: economic diversity, historical price growth, population size, and growth. It helps me define these markets into categories so I can quickly understand what sort of market I am looking at. So the first one I want to go through is high risk markets. Now, from the way I'm already been talking, you may realize that high risk markets are markets that are hinged on one main industry, either like tourism or mining. So if that industry were to collapse, that market could eventually go into a downtrend or a downfall in property prices. Not only that, these higher risk markets, they will usually have high yields, 8, 9, 10%, and prices can rise very fast, but they can crash just as quickly. And some examples of high risk markets that you may or may not know are places like Emerald, Queensland, Kalgoorlie, which we all know is a pretty famous mining town. And when you look at the data behind it, you can see you can buy a house for under 500k pretty easily with a yield of about 8%. So the property is essentially paying itself off, which is crazy. But when you look deeper into the data and you look at the historical price trends, you can see it has gone through cyclical price movement, through massive uptrends and then long periods of stagnation, as well as big downtrends based on how the economy is doing. And now we can see that Kalgoorlie is having another uptrend. But is this a market that I'm particularly interested in? Not really. Pretty much absolutely not, because it is a mining town. It is beyond my risk appetite and it is beyond my sleep factor. Can I sleep at night knowing I hold an asset that's $500,000 in this location? I can't, right? And even if it has extremely high yield and it's essentially paying itself off, to me, investing into a one mining town or a one trick pony town is not my cup of tea. Now, I want to state for a fact, have people made money in locations like this? Absolutely. If you time the market right, you play your cards right, and once you've made your money, you get out, then you can make money. But it all comes down to your own personal risk appetite. And I guarantee for 90% of investors out there, you probably can't do it and you probably don't have the tenacity to do it as well. It's just pretty high risk. Hence why I consider these markets like Emerald, Kalgoorlie, pretty high risk. Even though the data looks very strong, the market cycles usually last between 1 to 3 years. You will go through a steep uptrend, but then once you've made your money, you should be selling and you should be getting out. You don't want to hold an asset there for 15 years plus because you just don't know how well the economy will hold. All right. And the next type of markets that I actually want to go over is medium risk markets. Now, these markets is where 90% of investors like you guys will fall under, because they have a little bit of risk associated with them, but there's a good amount of upside to actually go ahead with properties in these suburbs. And these will include regional hubs / suburbs with decent yields and good growth potential. Now, I like to clarify these suburbs as suburbs or regional areas with a population of greater than 40,000 people. They're usually very economically diverse or diversifying. They're very stable. They have no big up or down swings. They may have gone through periods of stagnation, but overall they have been stable in terms of historical price growth. And some suburb examples that you will see is like Dubbo, Shepparton, Mildura, Bundaberg, and more. And they're usually great for medium-term plays. Then you can reassess whether or not the market is right for you. So after 3 to 7 years, you may look at the market. Is it still economically diverse? Is it still holding up in price? Or is it starting to stagnate? And then you can make a decision about whether or not to sell or continue to hold the property there. But let's have a look at some examples. And when you look at Dubbo's data, yes, it's $660,000, but you can find properties for around $550 with around a 4.5% yield. You can see that prices have been starting to grow steadily, but the key thing you notice between this and Kalgoorlie is that it hasn't had massive up or down trends. It's gone through periods of stagnation and slow growth, and it's gone through a big uptrend during the COVID time and now starting to rise again in value. This is what I consider a more stable medium risk location because it still has a smaller population of around 70,000 100,000 odd people from memory when you look at the entirety of Dubbo. And when you look at Dubbo's regional economy, you can see healthcare, construction, retail trade. No sector takes up more than 25% of the market. So for me, this is what makes me think about Dubbo as a good place to consider. It's economically diverse, it's stable, it's got affordable prices, decent yields, it doesn't have big up or down trends, and it's historically performed very well. So Dubbo is what I consider a medium risk location. And likewise, you'll find a lot of locations regionally will fall under this category. Not only Shepparton, you've got Ballarat, you've got Mildura, you've got Wagga Wagga, and more, right? And there's a lot more in regional Queensland as well as Cairns and Townsville. Townsville's a lower risk, I would say. But that's just some examples for you, right? But this is not all like perfect sunshine and rainbows, because they are great medium-term plays, but you also need to reassess the market every so often. Every 3 to 7 years, we need to make sure the market is still holding up. We need to make sure it's still economically diverse. We need to make sure the population isn't decreasing or people aren't leaving the location, because that will have a negative impact on house prices. So while they will help you sleep more at night, you still need to be proactive and understand how well the market is currently performing. Is there any detracting factors that you should consider if you were looking to sell? But generally speaking, medium risk markets are great. You can hold them for the long term as well, as long as all the basic functions, economic diversity, population is still good, in my opinion. So I hope that helps you understand what medium risk markets are. Let's talk about one more, and that is low risk markets. Now, this is a market where you can buy a property, you can hold it for the next 15 years, you can close your eyes and wake up with another $2 million in assets, essentially, right? This is metro locations or major regional hubs. They have good owner-occupied demand. Historically, their long-term growth is very steady. It's gone up. It's also gone through periods of stagnation, which is normal, but they usually have lower yields. You'll find them around 4 to 5%, but that's the trade-off, right? That is a trade-off, and if it suits your strategy, then you need to consider lower risk markets. Examples are like the Bendigos, the Albury Wodongas, with a massive population, like close to 100,000 people or more. Holding 10 years plus is absolutely fine in these locations, in my opinion. Like Bendigo is one of my favorite. It's very economically diverse. It's also like 2 hours away from the CBD of Melbourne, so it's very close. It is a major regional hub. I mean, all we have to do is just look at the stats behind it, and we look at the economy. It's got healthcare, retail trade, construction, education, training, manufacturing, and more. It is economically diverse. I have no issues from that standpoint. And when we look at the historical price trends, it has done very well, right? It has been a very, very steady growth, right? And this is one of those locations where I believe if you just buy and hold for a really long time, you'll make a lot of money. It's as simple as that. Yes, it's gone through a bit of a downtrend here, but that's because of all the massive price growth during the COVID times. And now we can start to see that Bendigo is once again performing, like I did say 12 months ago. So Bendigo is one of those locations where I consider it's a lower risk market. It has good quality assets. It's one to be on your list if this fits your strategy. Now, of course, you pay a higher price tag than the likes of Dubbo or Shepparton or Mildura, and a much higher price tag than Kalgoorlie. But if you're a low risk investor, you want to invest for the long term, you want to set and forget, like most people do, then this is the strategy that you want to go down, right? There's no point saying you're a low risk investor than buying a $400,000 asset in Kalgoorlie and then losing sleep and then fighting with your family or your fiance and then breaking up for it for no reason, right? This is what happens if you're not clear on your strategy and your finances. So it's really important to understand the markets that you're investing into, whether they're higher risk, low risk, or medium risk, because it will help you define about where you want to invest. And how do you know which market type to invest into? Well, that depends on you. You have to look at yourself in the mirror, decide how much of a risk do I want to take? Do I have family that depends on me? Do I have kids that depend on me? Am I a young student or a 21-year-old who's looking to get investing and I can take a lot of risk? That will determine which market you invest into. No strategy is the same for everyone. Play to your strengths. Till next time, thank you very much.